welcome to the Unit 2 of the course Management of Insurance Services. In this unit, we'll focus on the organization structure of insurance sector. In the first unit, we had discussed on the concepts of insurance as well as the different principles and the types of insurance. And this unit will cover the structure of insurance industry. What do we understand by the concept of underwriting? What are the different types of claims when you go for an insurance? And what is meant by the investments if when it comes to the insurance company? So we already know that broadly classifying insurance are of two types. One is a life insurance, other one is a general insurance. Now when we talk about life insurance, it is the scheme which covers the risk of human life. That means it provides the financial security to the dependents. It may be the children and wife after the death of the person who is the policyholder. And when it comes to general insurance, it covers the insurance of the non-life assets. That means suppose there is any unforeseen situation to maybe the crops, maybe the health of the individual, it can be the vehicle insurance or the property building. So that comes under the general insurance. Now, categorizing these two types of insurance broadly, the Indian insurance industry consists of, in total, 57 insurance companies, out of which 24 are in the life insurance business and 33 are into the non-life insurance business. Now, among the life insurance companies, LIC of India is the only company which is a public sector company. And apart from that, among the non-life insurance companies, there are 6 companies which are public sector insurance, which are not into life insurance. So the companies are the New India Assurance Company Limited, the Oriental Insurance Company Limited, the National Insurance Company Limited, the United India Insurance Company Limited, the Export Credit Guarantee Corporation of India Limited, and Agricultural Insurance Company of India Limited. So these are the 6 public sector companies or insurance companies which are not dealing with life insurance, which are dealing with the non-life insurance or the general insurance category. But whereas LIC is into the public sector, is the public sector company which deals with life insurance. Now, when we talk about these non-life insurers, there are some insurance companies which are very much focused and specialized to a particular aspect only. That means when we talk about a new insurance, New India Assurance Company Limited, so they cater to the different type of schemes which may lead to vehicle insurance, which may lead to health insurance, which may have property insurance. So they are having different types of schemes for different types of products. But when we talk, there are some companies which are specially into health insurance, which are specially into the agricultural insurance. So now let us discuss about the specialized insurers. So specialized insurers, this Export Credit Guarantee Corporation of India Limited is a specialized insurer. That means it only concentrates on the exports, which is of India. That means the seller of the products that he is selling abroad outside India, so he can take the benefit of this Export Credit Guarantee Corporation of India. So ECGC Limited is wholly owned by Government of India, and it was set up in the year 1957 with the objective of promoting exports from the country by providing credit risk insurance and related service for exports. So supposing a retailer who is or exporter who is exporting his products outside India, selling the products abroad outside India, and that means he has the risk of not realizing the amount of money which he will be receiving from the buyer who is staying outside India. So there is a credit risk there. So he has not realized the money before selling the product, but he will be realizing the money only when that entire product has reached the buyer who is staying outside India. So that is a credit risk. So here in that case, suppose there is a default in payment by the buyer to the exporter. In that case, this company or this organization insures the person and pays the amount which is sum assured. And of course, yes, the exporter will definitely have to pay a certain amount of premium at a certain interval period. So that means this type of companies is only providing insurance to the persons who are exporting goods or products to the buyers who are staying outside India. So it insulates the exporters. It supports or facilitates the exporters from losses arising due to buyers' insolvency. Suppose the buyer has become insolvent. Maybe the foreign countries, there is political instability due to which the currency, there might be impact on the currency, or any other issues will be arising due to political instability, payment defaults, or currency issues. So these can be few reasons due to which the exporter might not receive the payment. So at that point of time, the insurance companies will cover that risk. And of course, that same scheme goes that the its exporters will pay a premium. So it enables better access to export credit, since banks are more willing to lend when ECGC underwrites is in place. So whenever suppose exporter would like to the exporter would like to avail loan from any bank. So when there is a loan, he would like to raise loan from the bank. The credit worthiness of that exposure increases when there is a underwriting by the Export Credit Guarantee Corporation of India Limited. So that is why the chances of getting a loan from the bank becomes much higher when there is a underwriting or guarantee of realizing the payment by ECGC exists. So this bank is solely for the exporters. This corporation or insurance company is only for the exporters. Now there is another specialized insurer, which is Agricultural Insurance Company of India Limited. So as that the previous corporation was for exporters, the Insurance Company of India is only concentrating on facilitating the farmers. So here AIC was incorporated in the year 2002, and it aims to provide insurance coverage and financial support to farmers in failure of any of the notified crop as a result of natural calamities, pests, and disease, to restore their creditworthiness for the ensuing season. Like suppose there might be so many impact of nature on their crops or harvesting. So at that, suppose there is a fire in the crop. Suppose the pests have destroyed the crop, or there might be some other natural calamity. Suppose there is flood and the crops have been the crops have been flooded. So in that case, they can also have an insurance with the Agricultural Insurance Company of India, which safeguards the losses which will be or which has been made to the crops by different elements. So to encourage the farmers to adopt progressive farming practices, high value inputs, and higher technology, this type of insurance company also helps the farmers to stabilize their income, particularly in the disaster years. Suppose they have lost their amount, or they might not have been able to realize the amount which they have invested in the crops due to the natural calamities. Of course, the insurance company will be there to safeguard this their loss. So the plan provides comprehensive risk insurance for yield losses due to natural fire or lightning storms, hailstorms, cyclones. So these are different types of natural calamities which might have impact on the crops or harvesting of a farmer. So in that case, the agricultural insurance company is there to back up the farmers. So these are the specialized insurance. Now, apart from agriculture exports, there are 33 non-life insurance companies, which are public sector companies, insurance companies, which exclusively deals with health, personal accident, and travel insurance segment. So these companies, these six private sector companies, you might be very familiar with few of them also. So these companies are exclusively, these are also specialized insurers, but they deal with only health insurance, personal accident insurance, and travel insurance. So Star Insurance and Allied Insurance Company, Star Health and Allied Insurance Company Limited is one of the very renowned insurance company which deals with health and allied insurance services. Apollo Munich Health Insurance Company Limited, Max Bupa Health Insurance Company Limited, Religare Health Insurance Company, Cigna, TTK Health Insurance Company, and Aditya Birla Health Insurance Company. So these are few specialized insurers which takes care of export, which takes care of health, and which takes care of the agriculture. So in addition to these, there are few companies which are reinsurers. If you remember, in the unit 1, we had discussed about reinsurance companies. So reinsurance companies are those which safeguards the insurance providers to the individuals. If you can see this picture where the insurance is purchased by the individuals from the insurance companies. So here the individuals pay a premium to the insurance company. Now, these insurance company also take seek insurance from the reinsurance companies. So when they seek insurance from the reinsurance companies, then they also have to pay a premium to the reinsurance company. So insurance company, to safeguard their losses, they take insurance from the reinsurance company, and they have to pay a premium. So this is here. There are certain insurance companies like General Insurance Corporation of India, insurance company. The government had through the insurance laws has amended the Act 2015, and it had allowed the foreign reinsurers to also open their branches in India. So Insurance Regulatory Development Authority of India has given license to the following 8 reinsurers to set up their branches in India. So Munich Re means this is reinsurance, Swiss Reinsurance, SCORE, Hanover Reoc, RGA Life Reinsurance Company of Canada, United States, Lloyd's India Reinsurance Branch, London, Excel Insurance Companies India Reinsurance Branch, Hamilton, and ITI Reinsurance Limited, India. So they have been, these companies' branches have been already opened in India for reinsurance activities. Now moving on to the different types of associations or councils which are having the responsibility to frame the different schemes, which has the responsibility to fix the rates or slabs or tables, or the premium which will be provided by the different groups of policyholders, and also they are responsible to see that the sum assured also has to be relevant. So all the different principles and guidelines are discussed and framed by these type of associations and councils. So insurance council, again it is divided into two parts. One council looks after the life insurance companies only. Another council looks after the general insurance council. So, Life Insurance Council is a forum that connects the various stakeholders of only the life insurance sector. So, it develops and coordinates all the discussion between the government, the regulatory board, which is IRDAI, and the public. So, in short, it is the face of the life insurance industry. So, it is a platform where the government, the regulatory board, and the public, some representatives of the public, come to a common platform and discuss regarding the guidelines or the schemes or the different rates, as the case may be. How it will be more, how the insurance operation of the insurance will be more smooth and streamlined. So the insurance councils was constituted under the section 64C of Insurance Act 1938. The Life Insurance Council functions through several subcommittees and includes all life insurance companies in India. So it includes all the life insurance companies only. So in total, there are 24 life insurance who offer a variety of traditional and new innovative products. Nowadays, there are so many schemes which have come up with innovative products or innovative insurance schemes which caters to the need of the required or the requirement of the individuals or the farm. Secondly, there are insurance councils for general insurance policies also. So, General Insurance Council exists to provide leadership on issues having a bearing on the industry's collective strength and image, and to shape the influence decisions made by the government, regulator, and other public authorities within the country in order to benefit the industry collectively. So, to have a smooth operation or streamline the operation of the general insurance, that means non-life insurance or the insurance which leads with the property or leads with some specialized products. So in order to streamline all those aspects, there is a general insurance council. So the objective of this statutory insurance, General Insurance Council, is to expand the general insurance sector. So they will sit and deliberate on what more products can be taken into account when we talk about a general insurance. Other than, like, there are several specialized insurance uh, products, so there can be some more specialized insurance products which they sit and discuss so that the society or the people can be benefited at a large extent. They facilitate the economic development, provide long term funds for growth. They represent the general insurance company as an autocratic collective voice, and they resolve the social issues such as the insurance fraud or theft. So, this is what the role of the General Insurance Council. In similar line, the Life Insurance Council also operates. Now, apart from the council is a broader body. There are different insurance advisory committee also. So now the insurance advisory committee, where the regulatory authorities are acts as the chairperson, members acts as the chairperson as well as the members. So it was constituted under section 25(1) of the IRDA Act 1999 in accordance with the regulation 3A Insurance Advisory Committee regulation meetings regulation 2000, reconstituted via notification dated 25th May 2015. So the reconstitution, it was constituted in the year 1999, but the reconstitution was done in the year 2015. The IRDAI may establish the committee through official notification. The maximum number of 25 nominated members, which are excluding the ex officio members. Ex officio members are permanently there. The positions will be there, which apart from them, there will be 25 nominated members. So now these nominated members will be from different sectors like commerce, industry, transport, agriculture, surveyors, agents, intermediaries, safety and loss prevention bodies, research institutions, and insurance employee associations. So these 22 nominated members will be from diverse sectors and discipline so that they can holistically think about development of the schemes or the different policies. The IRDAI chairperson is the ex officio chair, so they will never change. This ex officio chair is always the IRDAI chairperson, and IRDAI members are also the ex officio members. So apart from these two ex officio chairs and ex officio members from IRDAI, there will be extra 25 nominated members. Now, the basic purpose and functions of the Insurance Advisory Committee is to advise IRDAI on formulation of regulations under the Section 26, and also they will provide the guidance on any additional matters prescribed by the authority. From time to time, if suppose there are certain issues which evolve during the process of by the proposer, or during the suppose there is any issue during claims, so all those issues can be taken up within the Insurance Advisory Committee. There is another committee which at least focuses on the tariffs, the rate, the premium, the consideration, the sum assured, which is mentioned in the different policies. So their focus is only on the tariffs. So there is that committee is known as Tariff Advisory Committee. So the TAC regulates tariffs, terms, conditions, and benefits for key general insurance line like fire, marine, motor, engineering, worksman compensation. So they deliberate on what should be the viable or fair tariff. Tariff here we mean the rate table chart in terms of the premium and the sum assured, their periodicity. So that will vary based on the different policies. So it ensures pricing discipline, the market stability, and uniform underwriting norms across the insurers. So what should be the pricing discipline, at what intervals, what should be the rate, whether that rate is in align with the market stability, and whether that rate will have an impact on market equilibrium, and the uniform underwriting norms, what should be the norms of the guarantor or the insurer. Underwriter is the insurer here across all the insurers. So the TAC functions as the official data repository for India's non-life insurance industry. It collects transaction level data across motor, health, and other general insurance lines. It supports actuarial modeling, risk assessment, and evidence-based tariff decisions. And it strengthens the transparency and data-driven pricing, enables the consistent underwriting standards across the general insurance industry, and supports IRDAI in policy reforms and sectoral oversight. So it's basically an official designated data repository for the general insurance, not for the life insurance. Now moving on to the different distribution channels of the insurance products. So when the insurers come out with the insurance products of, it may be relating to life or it may be relating to non-life products, so there has to be someone intermediary which should channelize or distribute those products to the beneficiaries or to the end users. So these are some of the distribution channels which intermediates the insurance products and sell it across to the, or take it across to the beneficiaries. Direct marketing, Direct marketing is directly the employees of the organization of the insurance company. They go and they visit different corporates or maybe individuals as the requirement of the policy, who are the beneficiaries. So they directly move on, discuss about their policy, and as per requirement they are providing the policies. So that is direct marketing. Similar in case of individual agents also, the companies recruit some agents which are not directly on the payroll of the company. They are not the direct employees of the company, but yes, there can be different agents who under the umbrella of that company can go and channelize the insurance products to the different beneficiary. There are corporate agents. There is another concept which is known as bank assurance. Bank assurance is like an insurance company will sell their insurance products through any bank. So that is bank assurance. So there are several examples nowadays, several banks where you will find the insurance companies products are sold or schemes are sold in the bank. That is known as bank assurance. There are insurance brokers who work on commission basis and who go on selling the products to the company, to the beneficiaries. It can be the corporate also, or it can be any individual. And there are insurance marketing firm, there are insurance services by common service centers also. So these are different platforms, or these are different individuals who intermediates or who sells, channelize the selling of the products, insurance products, to different categories of individuals for whom the product is made. Like you will find there are suppose you are willing to purchase a vehicle, a car. So in that with that dealer of the car, you will find an insurance company is already associated. So whenever you are buying a car or a vehicle, so you are going or to price that car along with the insurance of a particular company. So that is one type of channelizing the insurance products to the beneficiary. So, Insurance Repositories is a company formed and registered under the Companies Act, and which has been granted a certificate of registration by Insurance Regulatory and Development Authority for maintaining data of insurance policies in electronic form on behalf of the insurers. Earlier days, this concept was not there, because earlier when the policies were made, the form was sent in post to the person concerned, and you have to have the policy manually in order to claim the sum assured on maturity. So that was the trend. Or maybe suppose you want a loan from your where you want to mortgage your insurance form. So manually you have to submit that paper with the bank in order to raise a loan. So everything was manual on paper. But nowadays it has been completely electronic. Definitely it will be sent, the policies will be sent to the policy holder through the mail IDs. So that is in soft copy, as well as these are the repositories which has all the records of the individual person or the organization who are the policy holders. So they will have the record of the different of the premium which is paid at different intervals, and how much will be the sum assured, when they can claim their the sum assured after on maturity. Everything will be mentioned of that particular policy holder. So at present, the following four entities are acting as the insurance repositories. First one is the CDSL Insurance Repository Limited, Carvey Insurance Repository Limited, National Insurance Policy Repository by NSDL Database Management Limited, and CAMS Repository Services Limited. So here anyone can have their login IDs and password and get all the details about their insurance policies. Suppose we miss the insurance policy also, the repository can give all the information about the policy holder. Now let us move on to the concept of underwriting, which is the very pertinent, or you can say it is the most focused area when we talk about insurance. So underwriting here literally it means a type of guarantee. So underwriting is the name given to the procedure of assessing a proposal and deciding whether to accept the risk, and if so, at what rate of premium. So now, supposing a person has gone for life insurance. So in and his the scheme has the sum assured of around 10 lakhs. So now underwriting, in case of underwriting, the insurer, that means the company, and the proposer is the person. So the company will, insurance company will assess the form. The form will have all the details about that person. What is his background? What is his income? What is his health conditions? What diseases does he have? Whether he has had any sort of medical treatments earlier. So the underwriter or the insurance company will check all the different types of credentials or maybe health certificates, everything. He will get it checked and then decide whether he is going to accept the risk of that person. That means, suppose in case of death, the person is going, the insurance company is going to or is liable to pay. So in that case only they will decide, by looking into all this credential, the company will decide whether to accept the risk or not. And if they're going to accept the risk, then at what is the rate of premium. Like, suppose a person who is 30 years of age, the premium of a person who is at the age of 30 and the premium of a person who is at the age of 45 or 50, that gradually the rates increases, because as you start aging, your life risk also is starts the probability or chances of the death increases. So that is why in that case your premium also increases. So by assessing the proposal, the firm, the underwriter is the guarantor, the insurance company will decide on what should be the rate of premium. Now premium, as we have already studied in the first unit, that premium is means the consideration which is paid by the proposer. So the proposer is paying an amount of premium for what benefit? For the benefit to realize the sum assured if that sort of risk or that sort of loss happens in future. So premium is the consideration paid for predetermined benefits under the insurance contract. Every insurer has its own rate tables based on average mortality experience. Suppose there is a family insurance, health insurance of all the family members, the father, the mother, and the child. So now here also, when you see the father is aging, the mother is aging, and the child is also gradually suppose the child is in 17 years of age, and the mother is 40 years of age, and the father is 50 years of age. So obviously, as they age, their rates also will go on increasing. The premium rate tables means the premium also goes on increasing at certain intervals. Like, it will not increase every year. It will increase. Suppose the mother has turned 45, then the rate will vary. Suppose the father has turned 60, then the rate will vary. So the rate tables for different policy holders will be different, and that will be decided by the insurers. The proposed life may differ significantly. The age, health, occupation, lifestyle, which necessitates the risk-based pricing. So only because of this, it is necessary that the underwriter goes through all the credentials of that person. So underwriters accept, reject, or modify the proposals. So they either accept the proposal, reject it, or they make certain amendment on the forms. So accepted cases are further classified into standard lives, which are acceptable at ordinary rates. When you are at a certain age limit and you don't have any sort of diseases and all, you are good going, so you are accepted at a ordinary rate. Substandard lives higher than average risk accepted with extra premium. Suppose you are a diabetic patient, suppose you are a BP patient, of course there your risk is a bit higher, so you have to pay extra premium, but your case may be accepted. So this is done the with a motive to maintain equity among the policyholders by matching premium with the degree of risk. So when the risk is more, of course, the premium that you are paying to the insurance company will be more, and it is transferred to the insurance pool. Pool means the insurance premiums that you receive from different policyholders. Now, but every policyholder will not be paying the same type of premium. The premium will vary as per the degree of risk associated with their product or the policy. Now, there are basically two methods of underwriting. First one is the judgmental method of underwriting. So nowadays, this judgmental method of underwriting is not much followed, but however, you cannot negate this judgmental method of underwriting. This method was mostly followed in the olden days to underwrite the proposals. Under this method, the medical experts were used to examine the proposals and assess the risk. So whenever any person was giving the details that these are my diseases, or suppose I tell that I don't have any sort of disease, so in that case, the medical experts were asked to assess or examine the individual, and they used to use their judgmental to take underwriting decisions. So based on the experts assessment, the underwriter or the insurance company takes the decision of providing or accepting the proposer's policy. This was a slow process and highly subjective, so it took much time to materialize or take a proposal to be closed or accepted, and there were also not uniformity in the decisions which were taken, and different underwriters used to take different decisions because this was purely judgmental. So different types of underwriters, that means different types of insurance companies, the case may be one similar type, but different underwriters took different types of decisions. But nowadays mostly this next method, which is numerical rating method of underwriting, is taken. As you have a CIBIL score when you opt for loans in banks, so the normally when while providing loan to any bank to any individual, the banks assess the CIBIL score. So when CIBIL score is up to a particular, it's above a particular benchmark, then only he or she is eligible to get a loan. Similarly, here also you have a numerical rating method of underwriting. So today, the numerical rating method is universally used. This is simple, more objective and more scientific, and there is uniformity of decisions. So the processing of the proposal is done very fast, because you have to give ratings to the different segments. Like suppose the person is only having diabetes, then you can give a rating as 2 or 3. There are different procedures. So you have to give ratings, and supposing that they have a benchmark of around 200 or 300 points. Beyond that, you accept, or below that you reject. So that is how they are rating the different policies, and then they are going to accept or reject the proposal. So the numerical rating method is based on scientific studies called medico-actuarial investigations. Certain ratings are given to each of the favorable or adverse factors and a net rating is arrived at. So they have a rating system where you have to score. So it is based on numeric or quantitative, and when a particular benchmark is arrived, then only it is accepted or rejected. So depending on this rating, the underwriter decides whether to accept or decline a proposal, and whether, if it is being accepted also, whether an extra premium is necessary to be attached to that policy. Because if degree of risk is more, you need to attach an extra premium. Now let us move on to the claims, which is very necessary, or which is the concern of the policy holders. So now, after the policy that the insurance companies provide to any policy holder, any individual or the proposer, the policy is for a certain period of time. So after that particular period, the policy matures and the sum assured should be claimed by the individual or the policy holder, so that he gets the sum assured. So claim payments is the fulfillment of the insurer's promise and a legally binding contractual obligation. So the insurance company has made a promise or guaranteed or underwritten the policy. So now claim payment is nothing but the fulfillment of the insurer's promise and a legally binding contractual obligation. It is the most critical function of the life insurance company, directly shaping the credibility, trust, and future business flow. So whatever you have promised to the policy holder, it should be given back to the policy holder, and on the as per the maturity date. So if that does not happen, then the policy holders will lose their faith. There was one principle, good faith. So they will lose their faith, and gradually it will have an impact on the other potential policy holders also. So fast and efficient settlement strengthens the customer confidence. So after maturity, if the settlement of, if the money claim settlement is faster, then of course the customers or the policy holder will have self-confidence and they can go for other policies also. However, speed cannot override the genuineness. Every claim must be authenticated to prevent fraud and errors. So the payment of the right amount to the right claimant after verifying all the conditions is very necessary, and to maintain disciplined processes to avoid undue haste or negligence. So very much important is what is the sum assured, whether he is liable to get the entire sum assured, or whether he is not liable to get the entire sum assured and he should get a particular amount. That should be calculated properly, and that should go to the right claimant at the right time and accurate. So this is a priority when you settle the claims of by the insurance policy holders, by the insurance companies. So now when we talk about claims, the claims are can be of two types. So they can be maturity claims, there can be death claims. Now moving on to the maturity claims, the life insurance policy matures for payment on a stipulated date incorporated in the schedule of the policy bond. So it is a bond, it is an agreement for a certain period of time. So it will mature maybe after 10 years, 15 years. So in a life insurance policy, if a life insurance policy matures for payment on a stipulated date, so the date of maturity will generally be at the end of the policy term or the premium paying period. So you go on paying premiums at every year or every month till, let us say, 10 years, 15 years down the line. So when you stop paying the payment, that is the date of your maturity, and after that you can claim the amount from the companies, insurance companies. So amount of claim depends on the number of premiums paid under that policy. So it will be already mentioned in the policy or the bond when you might have purchased the bonds or the policy from the insurance company. Thus, it may be a full sum assured stated in the policy document. Suppose it is mentioned that if you pay a premium for the entire 15 years, then you will get a sum assured of 10 lakhs. Or suppose you have paid a premium of, let us say, 10 premiums, then you will get a sum assured which is a reduced amount. So everything will be mentioned in that policy when you purchase the policy. So maturity claims are known to the policy holder before, when he proposes that yes, he will purchase that policy from the insurance company. Now, maturity claims can be of different types also. It can be survival benefit payments, like let us say the case of money back policies. So here in the money back policy, the person is surviving and is getting the money back, the some percentage of that amount at particular time interval. It may be 3 years or 5 years. So that is what is survival benefit payments, not in case of death cases. So the contract in these cases do not come to an end because the term of policy does not expire. Only a percentage of the sum assured is payable without any bonus additions. So suppose you have taken a money back policy of, let us say, 3,000 every month, and you go on paying the money back, the premium of the policy till 5 years. So after the end of 5 years, you'll get a certain percentage. Let us assume 15% of the money deposited. Suppose you have deposited 50,000 or 1 lakh, you will get 15,000 to your account, and you go on continuously paying your premium till, let us say, 20 years or 25 years. So at regular intervals, the survival of, within the period of the survival of the policy holder, at regular intervals, the person will be getting the money backs, the in percentage, at regular intervals till 25 years, till the maturity. There are several other maturity claims like annuity payments. There is one scheme, say for example, you are organizing your pension plans. So suppose you are going to pay the insurance premium, let us say, for another 17 years or 20 years from now. And after that, after you cease to pay your premium, after that, post retirement, you will get a monthly cash or in your account, monthly amount of rupees, let us say 5,000 or 10,000 in your account. So that is an annuity payment. Annuity means it is equal payment. Equal payment, you are getting it every month or every year or every quarter. So that is, those types of schemes are known as annuity payments. There are few other types of maturity claims like discounted claims. Discounted claims, here the policy holder can surrender his policy. Like suppose any policy you have taken, and you discontinue to pay the premium, and you do not want to continue the policy because you would like to have your money with you. So you can surrender the policy and get the money, how much you have given as premium, as well as some sort of amount which is above that, but it will be the discounted of the surrender value. So there will be a fixed surrender value. So since you could not complete all the premiums, so obviously that you will receive the payment at a discounted amount. Settlement options in the installments. So it can be, suppose on maturity you are claiming for the money, for the sum assured, then what may happen that you can have claim settlements in installment. Like they can pay, first amount can be 5 lakhs, second amount can be 7 lakhs, third amount can, so the insurance companies can pay in different installments. But here it is not annuity, this is an installment payment in lump sum at different intervals. So there can be cash options also. So cash option is basically in case of a child policy, where here this type of policy, the parents are giving premium for the child policy until he or she obtains the age of maturity. At that point of time, after the maturity, the parents can claim for a cash return based on that maturity of the policy. So here they can get the amount of cash from the insurance company. Permanent disability benefit claims also are there, where you are obtaining the policy. Suppose there is an accident and you are permanently disabled. But here, one case is it is only the claims will be considered by the insurance company if the permanent disability has been occurred only due to accident. But suppose the permanent disability is a result of any sort of disease. Suppose a person is paralytic, then of course that will not, that policyholder cannot claim for that type of disease. So that is also a permanent disability. Now, the next type of claim is death claim. So, in this type of policy, it is a life insurance policy holders. What they do, they after the maturity, they can claim for the death claims also. But here it is where suppose the person dies. There are different types of claims here. Suppose the person dies within 3 years of the policy he has taken, then it is a very early claim. So that is known as a premature claim. So it is, since it is life assured for a death only, so it is it can be natural death, it can be death due to accident, or it can be death due to any sort of illness. So if the person dies very early within by taking this policy within the 3 years, that means he can die the next year or second year or third year, then it is a early claim. But if it goes beyond 3 years or it goes till the policy lapses, lapses is a date of maturity of that policy, then it is a non-early or a ordinary death claim. So here there are we have shown that there are different types of forms which we have to fill up while claiming for the death claims. So there is another term which is known as repudiation of the claims. So whenever the proposers at the proposer's end, the proposer's job is that they should propose for the claim of the money or the sum assured to the insurance company. Now, the insurance company's job is to scrutinize or properly go through all the documents, all the different types of forms and the supporting documents which have been submitted to claim the amount by the claimant or the policyholder. So, as the life insurance policy is a contract which is based on the principle of utmost good faith. So it is presumed that the policyholders will, of course, or obviously, will give all the supporting documents which are genuine and which are authentic. But again, the policy insurance companies, they have to assess or evaluate all the documents properly before they are giving the or releasing the payment of the claim. The proposer shall give all the information as would help the insurer assessing the risk involved in each case. A medical report also is obtained in some cases to arrive at a correct diagnosis. So suppose there is any sort of issues regarding medical, that also they can have a doctor who will have a medical examination and they can give their own opinion. Unless the proposer gives the proper answer, the underwriter who accepts the risk on behalf of the insurers cannot assess the risk properly. So it has to be on the principle of good faith by both, mutually by the insurer as well as the proposer. So based on the assessment of risk, some proposals are accepted at the published rates of premium and some are also charged extra premium because of the higher degree of risk, and some proposals also may be declined. By not disclosing the material information, the proposer violates the principle of the utmost good faith, and violation entitles that the insurer can also decline the claim. So there are also certain guidelines which are given by IRDAI in the settlements of claims. The Insurance Regulatory and Development Authority of India has issued many regulations to speed up the settlement of the death claims, because earlier there were the insurance company used to take number of days to settle the claims which are given by the claimants. So all the death claims requirements should be called for at one time and not in piecemeal. Suppose in that particular period there are 10 claimants for the death claim, it has to be settled at one point of time, not by face to face. So in that process, the process of settlement will be delayed. The claim should be settled or repudiated within 30 days of the receipt of the claim papers. So any individual or the policyholder who is applying for a claim, that should be settled within 30 days. The claim, he will get the money within 30 days. If a claim investigation is necessary, it should be completed within 6 months. In case there is a suspicious aspect which is being noted by the insurance company, then that claim should be, the investigation on that claim should be completed within a stipulated period of 6 months. If the claim are not settled within these time limits, there will be penal interest is payable by the insurance company, and the rate of interest is 2% over the bank rate. In case the company is prepared to settle the claim, but the claimants are not prepared to accept the same, then the interest at savings bank rate is to be paid for the delay in payment. So there are penalties which has to be paid by the insurance companies when it comes to delays in settlement process. And finally, we'll look into the investments. So in every insurance companies, what they do, they pool the funds or the premium from the different policy holders. So when there is a pool of resources available with them, pool of money or funds available with them, they are not going to keep their money idle with them. They will obviously invest in certain government securities. So the investments by the insurance companies are regulated by Insurance Regulatory and Development Authority of India, Regulations 2016. The accumulated total amount of investments made by the insurance sector are approximately 26,90,194 crores. Life insurance continue to contribute a major share of the total investments made by the industry, with a share of around 93% of the total investments. Similarly, the public sector companies continue to contribute a major share in total investments through investments by private sector insurers are going at a faster pace in the recent year. So there are several schedules, like here regulation 4A. Here the types of investment has been mentioned. This is given by IRDA, regulation 4A. There are several other regulations like regulation 6, regulation 7. In that category also it is mentioned like what percentage will be invested in what type of investment activities. But mostly the final agenda is that they will be investing in risk-free government securities. So they can invest in central government securities, they can invest in state government securities, and they can only invest in certain other approved securities like housing and infrastructure. These are approved securities, but they cannot invest in these approved securities more than 15%. Similarly, other investments, as and when, if you suppose find it out or invest in other securities, then also it cannot exceed 15%. So this is as per regulation 4, but these percentage will vary when it is under regulation 6 or regulation 7. Accordingly, the insurance companies are liable to make their investments as it is mentioned by the regulatory authorities. So this comes to an end of this unit 2. Next class will continue with unit 3. Thank you.